Greetings, fellow financial adventurers. Welcome to our channel Snap Savings, your fortress of financial wisdom.
Can you guess who are today's youngest millionaires? And no, they are not just trust fund recipients or Hollywood stars. They are none other than savvy teenage investors. With over 2,000 of them worldwide, these young millionaires with an average age of just 17 have managed to amass a collective net worth of a jaw-dropping $15 billion. Can you believe that? At a time when most teens are preoccupied with things like prom, these entrepreneurial whiz kids are busy analyzing stock market trends and building their fortunes. In fact, their combined wealth exceeds the GDP of some nations. It's a clear testament that age is nothing but a number when it comes to investing and wealth creation. Now, doesn't that make you wonder what's their secret? Let's find out. The earlier you start investing, the more time your money has to grow. Just as a seed planted in the soil requires time to sprout and grow, your investments need time to compound and expand. The principle of compounding, in essence, is the process of earning interest on your interest. It's a snowball effect. The more time you give your investments to grow, the larger the snowball becomes. Let's break this down a bit. Imagine you start investing $100 a month at the age of 25. Assuming an average annual return of 7%, by the time you reach 65, you'll have amassed over $340,000. However, if you wait until you're 35 to start investing that same $100 a month, you'll only have about $150,000 by the time you're 65. That's less than half of what you'd have if you started just 10 years earlier. This example underscores the power of time in the equation of investing. The earlier you start, the more you can leverage the magic of compounding, turning small, regular investments into a hefty sum over time. But it's not just about starting early, it's also about maintaining financial discipline. Regular, consistent investments can help mitigate the risks associated with market volatility. Sure, the market will have its ups and downs, but over the long term it's proven to trend upwards. Investing isn't a get-rich-quick scheme, it's a long-term strategy, a marathon, not a sprint. It's about understanding the potential risks and rewards and having the patience and discipline to stay the course, even when the journey gets tough. So whether you're a teenager with your first part-time job, a young adult starting your career, or someone later in life who hasn't yet started investing, remember this: it's never too late to start, but it's always better to start sooner rather than later. Remember, the key to successful investing is starting early and being consistent. Now, if you're new to investing, there are a few basic principles you need to understand. Let's start with diversification. Think of it as not putting all your eggs in one basket. By spreading your investments across different asset types and sectors, you can mitigate risk and potentially increase your returns. Picture a seesaw: when one side goes down, the other goes up. This is the essence of diversification. Next up, risk management. In the world of investing, risk and reward are two sides of the same coin. Higher potential returns often come with higher risk. But fear not, managing risk doesn't mean avoiding it altogether. It's about understanding it, quantifying it, and making informed decisions. It's like wearing a seatbelt in a car. You're not planning to crash, but if you do, you'll be glad you had it on. Another cornerstone of investing is the power of compounding. Albert Einstein reportedly called compound interest the eighth wonder of the world, and for a good reason. Essentially, it's earning interest on your interest. It's like a snowball rolling downhill, gaining size and speed the longer it rolls. The key to harnessing this power is time. So the earlier you start investing, the more your money can grow. Lastly, let's talk about long-term investing. Investing isn't about getting rich quick, it's a marathon, not a sprint. The stock market has its ups and downs, but historically, it has trended upwards over the long term. So don't panic when you see short-term fluctuations. Keep your eye on the prize and stick to your investment strategy. Remember, investing is a journey. It's about growing your wealth over time, achieving your financial goals, and ultimately securing your financial future. It's not a get-rich-quick scheme, but with patience, diligence, and the right principles, it can be a path to financial independence. With these principles in your arsenal, you're well on your way to becoming a savvy investor. All right, ready to start investing? Here are some simple steps to get you started. Step 1. Set your financial goals. Before you start investing, it's crucial to know what you're investing for. Is it for retirement, a down payment on a house, or maybe your child's education? Your goals will determine your investment strategy, so take some time to think about what you want your money to achieve. Next, educate yourself. Knowledge is power, especially when it comes to investing. You don't need to be a Wall Street whiz, but understanding the basics is essential. This includes terms like stocks, bonds, mutual funds, and ETFs. There are plenty of free resources out there to help you learn, so take advantage of them. Step 3. Choose the right investment platform. There are countless platforms out there, each with its own set of features and fees. Some are great for beginners, while others cater to more experienced investors. Do your research, compare different platforms, and choose the one that best fits your needs. Now, on to step 4, start small. Investing can feel overwhelming at first, so it's crucial not to bite off more than you can chew. Consider starting with a small amount that you're comfortable with, and gradually increase your investment as you gain more confidence and experience. Step 5. Diversify your investments. This means spreading your money across different types of investments to reduce risk. Don't put all your eggs in one basket. Instead, consider investing in a mix of stocks, bonds, and mutual funds. This can provide a balance of risk and return. Step 6. Keep your emotions in check. Investing can be a roller coaster of emotions, but it's important not to let these feelings drive your decisions. Stay focused on your long-term goals, and don't panic when the market takes a dip. Remember, investing is a marathon, not a sprint. Finally, step 7, review and adjust. Your financial goals and circumstances will likely change over time, so it's important to regularly review your investment strategy. This could mean adjusting your portfolio, adding new investments, or even changing your goals. The key is to stay flexible and adapt as needed. And there you have it. You're now ready to make your first investment. We've covered a lot today, so let's quickly recap. We started off with some startling statistics, highlighting the immense growth potential of investing in the long run. The figures were not just impressive, but they were also a wake-up call, underscoring the importance of starting early with your investment journey. We then dived into the heart of the matter, exploring why investing early is so crucial. We learned that the power of compounding is an investor's best friend. It's the secret sauce that can turn modest savings into a substantial nest egg over time. Remember, the magic of compounding works best when given a long runway. Next, we delved into the basic investment principles. We learned that diversifying our investment is a key strategy to mitigate risks. We also understood the importance of sticking to our investment plan, even when the market seems to be heading south. Remember, it's about time in the market, not timing the market. Then we moved on to some simple steps to start investing. We understood that the first step is always about gaining knowledge, followed by setting clear financial goals. We also discussed the importance of choosing the right investment platform and starting with small, manageable investments, but learning doesn't stop here. For those who want to dive deeper, there are many resources available. Books, online courses, podcasts, and mentorship programs. Use them to your advantage. Remember, investing is not just about making money, it's also about financial independence, about securing your future, about making your money work for you. It's a skill that can transform your life, but like any other skill, it requires practice, patience, and persistence. So as we wrap up, here's the final thought. Don't wait for the perfect moment to start investing. There's no such thing. The best time to plant a tree was 20 years ago. The second best time is now. Investing is a journey, not a sprint. So take your time, do your research, and remember, the best time to start is now.
Don't forget to like, share, and subscribe for more profound insights into mastering your financial journey.